There's a video I watched on the internet, and that video created a lot of fight and confusion in the entire Forex community. And that video was just simple, it was on the concept of time frames. And what actually happened? There were these two gurus, right? I'm sure you guys must have watched that particular video. So these gurus all had, or these mentors, all had their Forex trading academies. And the first mentor gave a signal on gold and said, buy gold at this price, blah, 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 blah. The other person gave a signal to on gold at the same time and said, sell gold at this price, blah, blah, blah. So now traders took that thing to the internet. They were like, no, look at how all these Forex mentors are scamming us. They don't know what they are doing. How can this mentor say, let me buy gold at the same, and then at the same time, this other mentor is telling me, let me sell gold. So when that was brought to my community at Godlove University, one of my students, or the students, they sparked it in a Discord community, and they were discussing. And I stepped into the community and I educated them on a lot of things. The first thing I addressed was about the video. I told them that there was nothing wrong with the video because these two traders, I can shock you, all these two traders made money at the end of the day. All right, yeah, I'm gonna clear. Don't worry, I'm gonna clarify. I'm gonna tell you why I'm saying that, so that at the end of the day you won't be confused. Don't worry. All these two mentors or all these two gurus made money at the end of the day. Why? Because of the power of time frame, because of what we call time frames. Guru number one was using a higher time frame, so something like the 4-hour time frame. So he was more like a swing trader. He gave his analysis on gold to say, okay, buy gold at this price, and then stop loss at this price, take profit at this price. So I'm just going to use a common chart here, right? You can see this is a daily time frame, 4-hour time frame, 1-hour time frame, and a 5-minute time frame. So that trader might have given, let's just take for example, the one who gave the buy signal, right? So he said buy gold, and maybe he gave a signal somewhere here. He was supposed to go out somewhere there. And remember, when it comes to the daily time frame or the 4-hour time frame, a small retracement, I mean the overall trend can be a bullish trend, but just a small retracement can be an overall trend in a lower time frame. All right, I mean just a small retracement on the higher time frame like the 4-hour time frame can be the whole downtrend on the lower time frame like the 1-hour time frame or the 5-minute time frame. So the first guru was very correct. He gave his buy signal and the market went in his favor. Meanwhile, the market was going in his favor. The market wouldn't just go like a slingshot to just go boom and hit your take profit. No, the market breathed out and breathe in, breathe out and breathe in, like something you are seeing here. The market, you see, extend and decrease, and just this small retracement here, or just this small moment where the market is breathing in, the second guru can take now to the 5-minute time frame to say sell gold at this price and then exit at this particular point in time. So he's still going to make money, and in short, he still made money at the end of the day. Because I look to the bottom of this, at the end of the day, both traders were able to make money because of time frame. So anytime or next time you see a video like that, don't be quick to judge, because there's one concept in the Forex market which is known as the concept of what? Time frames. Now, let's take an example now on, let's just go on our board and we'll take the examples we have here, and I'll be able to explain what I want to explain to you guys, right? When it comes to the Forex market, we have different time frames. We have the monthly time frame, which is just M1 or so. We have the monthly time frame, the weekly time frame, the 4-hour time frame, the 1-hour time frame, the 30-minute time frame, the 15-minute time frame, 5-minute time frame, the 2-minute time frame, and the 1-minute time frame. Those are the major time frame. I've even seen in some communities or in some platforms you have even a 3-minute or a 2-hour time frame. But those are just the major time frame. When it comes to a time frame, what is a time frame? So a time frame is very subjective to the particular frame of action you are using to make your decision. For example, if I'm making my decision based on the daily time frame, it means I shouldn't be too concerned with what is happening on the 4-hour time frame. I shouldn't be too concerned on what is happening on the weekly time frame. I can only use that as a point of confluence to trade. So let's start with the first example. You can see trader number one, UT just stands for upper trend, DT stands for a downtrend, then there was a consolidation and a downtrend again. So let's go through these examples for you to understand what I'm saying, right? You can see trader number one had what was on an uptrend, and then here, while trader number 1 was on an uptrend, you can see here we had a consolidation. And just this small consolidation you are seeing here, if you have to zoom it out, you can see what we had here. It was a whole downtrend on what? On the 4-hour time frame. The small consolidation we had on the daily time frame was a whole downtrend on what? On the 4-hour time frame. Meanwhile, we were having a downtrend on the 4-hour time frame. At the end of that downtrend, we had something here, which was more, you know that thing where the market goes like this, and then you just see something like this. Just this small place. That small place alone on the 4-hour time frame was a whole what? Was a whole support and resistance, or a whole consolidated market. You know, a consolidated market is where the market is neither on an uptrend or a downtrend. The market is neither bullish or bearish. So just this small place you saw on the 4-hour time frame was this whole place on what? On the 1-hour time frame. And why this whole place was a consolidated market on the 1-hour time frame, just this small area here, just this small area, you know the market is bouncing on this, right? And you can call all of this is a consolidated market. The market is bouncing on support and resistance. But just this small area here on the 1-hour time frame, this is what was what? A complete downtrend on the 5-minute time frame. Can you see? That's why you see two people, you can see two traders. This person, they can be looking at the same chart, and one person buy and the other person sell, and at the end of the day, they all make money. Because that first person who bought was using a daily time frame. Maybe he bought somewhere here, his take profit was somewhere here. And meanwhile, he was waiting for his take profit to hit, and then someone came in and he saw that there was supposed to be a retracement in the market somewhere here, and entered somewhere here on a sell on the 4-hour time frame, and still ended up making money. Meanwhile, he was on a sell on a 4-hour time frame. Someone came and saw the market bouncing on support and resistance on this 4-hour time frame, immediately stepped down to the lower time frame, which was a 1-hour time frame, and was just trading on support and resistance. The market will just come here, the person will buy here. The market will go up, the person will sell. The market will come down, the person will buy. Go up, the person sell. Come down, the person buy. So by the time the market, maybe after this trend, you see the market continue going down, but this person on the lower time frame, like the 1-hour time frame, has already made a lot of money and is done. Meanwhile, this person is still waiting for the take profit to hit. Meanwhile, this person is bouncing on support and resistance, just this small area here, while he's waiting for the market to move from support to from resistance to support. This person is just here on the 5-minute time frame, entering hundreds upon hundreds of trades as the market. So you can see the power in time frames. You need to be able to understand how different time frames react so that you can use it to make a good point of confluence when it comes to trading. Now, this is how you use it in trading, all right? When it comes to trading, I normally call it, let me check the ticker one. I normally call, there are two types of traders when it comes to time frames. You have what I call the strong signals, right? S signals, strong signals traders, and you have the weak signals, right? The weak signals. Don't just see it because it's weak signal. You think maybe this one is less important than this one. No, let me explain what I say or what I mean, right? Something like a strong signal is a concept where, because you know, I also develop a lot of Forex algorithms like Forex robot, AIs, and all of that, right? And when I was working on a particular tool which has become the most viral Forex robot now in the Forex space, known as Patrex Pro, there was something that came to my mind because I wanted to develop something where you can choose how strong you want your signal to be, which in that particular tool we call it the signal strength. Just to give you an example on how it works, the signal strength, we tend to use different time frames to look for a stronger signal, all right? So now the same thing can apply for you even trading manually. So for a strong signal, let's just say you want to trade, you are a day trader, you want to trade on two time frames. The first time frame is a 4-hour time frame where the market is on a bullish time. You can see the market is bullish on the 4-hour time frame. And then you want to trade on what? Push 4. You want to trade on the 1-hour time frame. What do? I always advise people, if you are a strong signal trader, make sure the decision you are taking on the 1-hour time frame must be in accordance with the decision on the higher time frame, or the market direction on the 1 hour time frame or the lower time frame you are using must be in accordance with the direction on the higher time frame. Meaning, if the market is buying on the 4 hour time frame and you're looking for a decision, you're looking for a trading decision on the 1 hour time frame, you need to wait for the market to give you a buy signal. And how do you do that? Maybe the market is buying on the 4 hour time frame, and then here you see something like this. Maybe the market has gotten here and you see something, you see the market start pulling back. This is a typical pullback, right? A typical pullback, right? Where the market start pulling back here. What would this person do? Someone who is trading on the 1 hour time frame will immediately just go to the 1 hour time frame and wait for the market to pull back. As soon as the market is getting here, remember that pullback, you'll be seeing something like this on the 1 hour time frame. The market is going to be a whole trend on the 1 hour time frame, and then this person will just be looking for what? For a reversal signal. Maybe a reversal signal on the 1 hour time frame. You can see something like this. Can you see that? Double bottom, first bottom, second bottom. They can still be candlestick pattern. It can still be bullish engulfing candlestick. It can still be the marabouts. I'm just giving you. You can look for. There are many reversal signals. So just a first reversal signal somewhere here, which is going to be this on a 4 hour time frame. This person will be able to enter here on the neckline. Stop loss here. Go for a risk to reward of at least 1:2, and boom. So can you see? So the person waited for the market to give him a buy signal before he could buy. Because of what? Because the market was buying on the 4 hour time frame. The same thing applies, or something similar applies to what? To a weak signal trader. So for a weak signal trader, you don't care. You don't care whatsoever is happening on the higher time frame. You focus on one time frame. Most of the time I trade like that, depending on how I'm feeling that day, depending on my sentiments. Sometimes I just open my chart. If I'm focusing on the 1 hour time frame, if I'm to use a moving average or I'm to do it, I just focus there, do my analysis, place my trade. I don't care what's happening on the high time frame. That's an example of a weak signal trader, right? Which I'm a weak signal trader sometimes. I don't want to keep bothering myself or confusing myself on what is happening on a high time frame. So what would this weak signal trader do? The weak signal trader will just come here, and on the 4 hour time frame, the person will see the market is buying. The market is buying. The market is buying. And then what will the person do? Just assume the market is already here, then here, and the person can see this pulling down. Maybe the person has already drawn this. The person has already drawn trend lines, or use other tools like maybe the Fibonacci tool. Because the Fibonacci tool, how does the Fibonacci tool works? If this is a 4 hour time frame, you just come and bring your Fibonacci tool somewhere here. Remember, I'm calling tool because this will give you different points of confluences. So someone who is using the Fibonacci tool will just come here and just put his fibs and draw his fibs from here to here. All right. So drawing the fibs from here to here, remember there are going to be levels. You're going to have levels inside here, like the 18%, 30%, 50%, and all of that. So by the time the market is pulling back to the 50% or the 38% level, which is the advisable level for you to buy, you can see we also have another point of confluence here. So you have 2 points of confluences. The first one is the market pulling back to your 50% level, the 50 or the 38% level. And the second one is the market pulling back to your support or to your lower trend line. As soon as it gets here, boom, you enter somewhere here on the buy, you buy somewhere here, your stop loss goes somewhere here, take profit here, risk to reward of 1:2, boom, you out of the trade. As easy as that. As easy as that. Trading sometimes is just a game of simplicity. Keep it simply stupid. Don't overcomplicate your chart. Don't overcomplicate the game. You need to ask yourself, am I a strong signal trader or a weak signal trader? If you're a strong signal trader, it means you're going to be using the higher time frame to do what they call top-down analysis. Top-down analysis is not new in the industry. It has always been there. Even though I see some people will take it now and then they explain it as if it was something that was discovered in 1920s. It's always been there. It's the same thing like ICT, all right? Something they call ICT, smart money concept. It's always been there. Fair value gap. It's gap trading. It's always been there. But you see someone who take it and then repackage it and explain as if he's reinventing the wheel. No one is reinventing the wheel. When it comes to this space, there's no new message. They are just new messengers, all right? There's no new message. They are just new messengers. So don't complicate yourself. If you are a strong signal trader, you know you are using two time frames. One time frame is going to be able to tell you what's happening on the macro level. Then the smaller time frame is the one you are using to take your trade. Then you wait for the market to confirm the same direction as on your high time frame before you can take the trade. The same thing goes here. If you're a weak signal trader, which I am a weak signal trader sometimes, it means you don't want to use any other time frame to confuse yourself. Then the same thing will apply. You just come here, you pick one time frame. My favorite is the 4-hour time frame and the 1-hour time frame. So taking something like the 1-hour time frame, if the market is bouncing, so long as I've been able to plot my support and my resistance, I can use trend lines and then bring in other tools like the moving averages or the Fibonacci tools to look for points of confluences. I've already given you guys an example here on how you can use the Fibonacci tool and also use trend lines to be able to look for a point of confluence for a high probability trade. Remember, I'm saying a high probability trade. When it comes to trading, trading is a game of probability. You can do all of these, bring in the same strategy that has been working for the past 10 years. You don't know what's going to happen. That trade might still go south. That trade might still blow out. That's trading. Trading is a game of probability. You accept the risk and you move ahead. So if you guys have picked anything on this particular video, let me know in the comment section. And as always, if you haven't subscribed to my channel, guys, smash that subscribe button below to subscribe to the channel. I'm just talking about a tool which we have something similar like this in that particular tool where you can choose how you want your signal to be strong. You can allow the robot is combined, is having 5 strategies combined with AI, which is known as Patrix Pro. Then also check the link on the video description. The robot is 100% automated. You don't need to do anything. The robot is going to analyze the market, execute the trade, and also manage your risks. And if you want me to mentor you one-on-one, or if you want me to be your mentor, you already know what to do. Check out Godlove University, link on the video description. If you want my recommended pro firms, my recommended brokers, if you want to join my free Telegram community where you can download some of my free ebooks that I've already bought, then I'm giving them for free. Also check all the links on the video description. Check out these videos that are going to be coming at the end of the screen because I've programmed those videos just for you. And if you haven't subscribed, click here to subscribe to the channel. See you guys on these other videos. Peace.